Today, I'm going to be covering a concept that I find incredibly useful when evaluating trading strategies. It's a concept developed by Van Tharp called R-values or R-multiples. And I find that this can also be really useful when evaluating which parameters are most effective from an optimization. So stay tuned. There are significant benefits of using Van Tharp's R-multiples model compared with some of the alternative ways of assessing the trade characteristics of your strategy. So let's take a look. I first came across the concept of R-values or R-multiples from a book called Trade Your Way to Financial Freedom by Van Tharp. And I think I got my first copy of this in about 2008. It was a second edition. However, the book was initially published, I think, in the late 90s. And so it's a relatively old book now, but it is absolutely ram-packed with great ideas for developing trading strategies and also position sizing and assessing the effectiveness of different trading strategies. Now, the R in R-multiple stands for risk. And this is because these metrics are intrinsically linked to the risk associated to individual trades that are produced by your strategy. And so therefore, it's also very much linked with your stop loss strategy. Now, you can think of the R value for a trade as being equivalent to the maximum risk that that trade will be exposed to during its lifetime. And this, of course, means that it's based on when your trade closes at the stop loss. And this can often be referred to as the worst case loss of the trade. So let me give you an example of how it's calculated. Let's say from this price action, we open a trade here. And because this is a long trade, the stop loss will of course be below this level. So here's an example of a place where you might place that stop loss. Now, in this case, of course, after the trade opens, although it goes in the favour of the trader initially, it then comes back and eventually closes at that stop loss level. And it's the difference between the entry point and the stop loss that we use to calculate the basis of our R value. So when the price hits the stop loss, this always has an R value of -1. So let me just talk now about the logical setting of stop loss values. This should almost always be done based on a logical level determined by the premise of your trading system's rules. And so the actual price that you set as your stop loss shouldn't be anything to do with your position size. It's only after you've set the level that you should then do a calculation to determine the position size that will give you your desired risk based on that predetermined level. And so examples of a desired risk might be, for example, 1% per trade or 0.5% per trade. And this percentage, of course, is based on the equity in the account at the time you open the trade. And by doing it this way means that you can now use the R multiples to better comprehend the profits and losses of your trades. And this actually has huge benefits because it helps you with your understanding of how your trading system's actually working and can also help you to evaluate the results of optimizations. Let me show you what I mean. Let's start off in the same place that we did previously, opening a trade at this particular point. But this time, let's say that the logic of our trading system meant that we set our stop loss at this level. So this time, the stop doesn't get hit. And instead, let's say we exit here for a profit. So what you can now do is still calculate your R value using the stop loss because that still represented the maximum potential loss of the trade, and we can then use that to calculate the R value of the profit-making trade. So in this case, because the difference in price between the open and the close is 1.8 times that of the maximum loss, this is classified as a 1.8R trade. And why does this produce such a clear visualization of the profits and losses of the trades that are created? Well, let me give you an example. Let's say that your decision was to risk 1% of equity on each trade. So naturally now, the 1R value of the stop loss represents that 1%. Because of course you determined your position size to ensure that it was 1%. And then from that, we can determine that the profitable trade we just saw, which had a value of 1.8R, would make 1.8%. So one of the benefits of this is that we can now use these R values to compare trades in a like-for-like way as part of the evaluation of an optimization, and they all carry an equivalent weight. And what I mean by that is that they all have the same influence on the eventual score of the system. Now, if you don't have a way of doing this and comparing trades, what can happen is that trades that are taken when the equity is high and therefore have a larger position size will contribute much more to the performance metric than trades that were taken when the account's equity was much smaller. And so you get this imbalance where some trades are influencing the score a lot, others aren't influencing it hardly at all, and this has the effect of diminishing the statistical significance of your results. But by taking this approach, a 1.8R trade always has the same influence, regardless of whether that made you $200 or $2. And that's exactly what we want to give us a fair comparison and to make the results of the optimization as meaningful as possible. What it also means, if you're trading some kind of pattern-based strategy, is that the actual size of each of the patterns that lead to a trade, again, still have an equal influence regardless of how big they were. And in terms of generalized rules, again, this is what we want. But of course, up until now, we've only considered single trades. To get a better idea, we need to put together what's called an R-multiple distribution. And so, as a quick example, let's say we have 8 trades. This is what the R values from each of those 8 trades might be. Now, in reality, of course, 8 trades is hardly any trades at all. And so in order to make your analysis statistically significant, really you need to be aiming for thousands of trades and calculating your R-multiple distribution across those sorts of numbers. Now, it's quite useful to sometimes look at real-life examples that illustrate this particular point. And on the Darwinex platform, there's the concept of investable attributes, and there's 12 of these for each trading strategy on the platform. And so by clicking here, you can see the 12 attributes, and these relate to things like risk stability, duration consistency, loss aversion, performance, capacity. But the one we're interested in is this positive return consistency and negative return consistency. And so let me explain what we've got here. Along the x-axis, you've got the return in pips, and note that this is a logarithmic scale, so each increment here is doubling. And then on the y-axis, we have the position duration, so how long the individual position was open for. So if we take a look at this one, for example, we can see that the trade resulted in a profit of 28 pips and the duration was 11 hours and 23 minutes. So each of these dots represents an individual position that was open. Now, I've chosen this particular strategy because it has a particularly consistent stop-loss approach. So you can see that when a trade does lose, it usually goes the same distance in terms of pips. And so based on the topic that we're talking about, this is actually a very clear minus R value for the stop loss. And as you can see, that's at around 5 pips. Now, there are quite a lot of trades that close here, and that might be due to some break-even stop loss that's being used potentially. But the majority of profitable trades close over here. And as I said before, it's a logarithmic scale, so the average here is probably around 35 pips. So if you think about this in terms of R multiples, a 5 pip loss is equivalent to minus R, and therefore the R value of these profitable trades, which is 35, is approximately positive 7 R. There's a couple of examples here which are both at around 5 pips, and so these would be positive 1 R trades. And so you can see by combining all of these trades together, we can get our R multiple distribution. But why is having this R multiple distribution useful? Well, it's because we can use that distribution to calculate what's called the system expectancy. And this is another great tool that was devised by Van Tharp, but more on that in the next episode. If it's already available, you'll see it top right. Please remember to give me a thumbs up, and now until next time, trade safe.